The global economy right now looks like it's being punched in the face. Since that moment, some dubbed Liberation Day, the bond market has roared, yields have exploded, and the US has started trading like a banana republic. Today, we'll look at the market signals, hinting at exactly what the finance world thinks about America's future. Picture this: a beat-up car hurtling down the highway, driver totally wasted on debt. But that drunk behind the wheel, that's America. And the person riding shotgun who just grabbed the wheel, that's the bond market, reminding us who's really in charge. The question is whether that market drives us off the road, because this administration has eroded decades of US stability in a matter of weeks. The problem is, this isn't just a Wall Street drama. Your retirement plans and your economic future are sat in the backseat. So how's everything gonna turn out? Are we headed for a cliff, or have we already driven off of one? In this video, I'm gonna explain the realities of what the market signals are telling us about just that question. So let's get into it. If you're new here, hi, I'm Daniel. I turned my tech career and knowledge of finance into seven-figure wealth by my early 30s. And now I'm sharing the blueprint for you to grow your assets, no Wall Street jargon needed. So the last few weeks have been nuts. While politicians were tweeting nonsense and the stock market was melting down, the bond market, the biggest, most powerful financial force on the planet, stepped into the ring. We're talking a market where US treasuries alone trade around $1 trillion a day. Equities, a paltry $200 billion. Basically, stocks are the kids' table. The bond market is where the adults argue about the bill. Sure, the currency market is bigger at $7.5 trillion a day, but bonds set the rules. As James Carville, a senior Democratic political advisor, famously put it,
if there was ever reincarnation, I used to think I wanted to come back as the Pope or the President or foreign baseball hitter. But the truth of the matter is I'd like to come back as the bond market because I can intimidate everybody. What that was me recognizing how utterly powerful the bond market is. Way more people in the bond market than the stock market. It's way more important.
Man, has it intimidated in the last few weeks. The 10-year yield jumped from 3.86% on April 4th to a gut-wrenching 4.5% on April 9th. The 30-year yield increased 52 basis points, 0.5%, to 4.92%, marking its largest three-day increase since 1982. That's over 4 decades ago. Which, if you're keeping track, was the last time ET was phoning home, and everyone agreed on leg warmers. That's how unusual this is. This spike was fueled by investors' fears that the administration's aggressive tariffs, peaking at 145% on Chinese imports, would not only spark inflation, but massively increase US government borrowing costs. Okay, so yields rise, money should flow into the US for better returns, right? That usually makes the dollar stronger. But here's where things get wild. The dollar tanked 4% against other currencies at the same time. Yields up, dollars down, that's not how it's supposed to work. Our reputation as the safe haven, where dollars and treasuries are like solid gold, it's eroded more in the last few weeks than in the last half-decade. We're starting to look less like a superpower and more like an emerging market, at the mercy of outside forces. Think about it. For decades, we had exorbitant privilege. The world needed our dollars and debt, which meant that foreign governments essentially subsidized our lifestyle and kept our borrowing costs low. That's why our economic sanctions had teeth. But when bond yields spike like that, and the dollar falls, it screams the world is losing faith. This isn't just abstract financial jargon. When the costs of borrowing spike like that, it directly impacts your mortgage rates, the interest on your car loan and credit card, and the cost of capital for companies you might work for or invest in, courtesy of the guys driving the car, playing bumper cars with global stability. So who exactly was hitting the sell button? Who owns our debt? China is the second largest holder of US treasuries and the largest holder of US dollars, over 3.2 trillion. Europe and Japan also hold around 10% of our debt. Now, did they cause the spike in bond yields? Despite the US 10-year yield rising, making US relative yields more attractive, and the US-China interest rate differential, which is the difference between our interest rates, falling, the Chinese yuan strengthened against the dollar. This defies typical interest rate differential correlations. Similar to China, Europe and Japan also showed divergences. Their currencies, the euro and the yen, strengthened even as their interest rate differentials were decreasing against the dollar. This unusual market behavior, US yields up, dollars down, foreign currency strengthening despite interest rate differentials, is consistent with foreign entities selling US treasuries. When a foreign country sells US treasuries, a dollar-denominated asset, they get dollars. If they don't want dollars, they sell those dollars to buy their own currency. This action simultaneously pushes yields up and the US dollar down. This weakens the dollar and strengthens their own currency. This market action is suggestive, but we won't have definitive proof of who's selling until the official Treasury International Capital data is released, which is several weeks after the month ends, because of course it is. We're trying to figure out who set the global economy on fire, and the data arrives by carrier pigeon apparently. The divergence suggests that capital flows might have not been driven by typical yield-seeking behavior, but potentially by large strategic decisions by institutional investors abroad or foreign central banks. When the world loses faith in Uncle Sam's IOUs, it's not just geopolitical theater. It makes the whole global financial system less stable. And guess who lives in that system? We do. When it comes to China, a trade war already means pain for both sides. Therefore, China already has less to lose by using their debt holdings against us. Sure, it hurts them too, but do we really want to enter into a pain battle with a country that is truly authoritarian and that did actual lockdowns while we were fighting about toilet paper? I'm genuinely not sure if we have the pain tolerance for this economic war. If you want proof that the bond market dictates terms, look no further than Liz Truss, the UK Prime Minister who lasted a whopping 44 days on the job in 2022. She proposed some unfunded tax cuts, spooked the bond market, yields went vertical, and she was outlasted by a head of lettuce. No, seriously, a head of lettuce won a longevity contest against her. The bond market doesn't negotiate, it dictates. And with yields flying up, Donald Trump backed down, and we got a sudden market-mandated 90-day pause on tariffs. They blinked, they had to. And the evidence that they got the message, suddenly figures like Scott Bessent seem to be playing the appeaser or good cop role, while Howard Lutnick and Peter Navarro have disappeared off into the mist. The administration for now seems to be walking back from the brink a little bit. Perhaps because, as some experts put it, we were trading like an emerging market. Lesson learned. The bond market does not care about your political ideology. All it cares about is stability. Then you have to add the Fed to this mess. They're frozen, caught between inflation risks because of tariffs and a slowing economy, also thanks to tariffs. It's a stagflation nightmare. And with Trump threatening the independence of the Fed by saying Powell should go, that kind of noise trying to bully the Fed is dangerous. And the markets took a huge downturn on Monday because of it. Look at Turkey, where their president Erdogan keeps on firing central bankers who won't play ball. That got them runaway inflation and a trashed economy. Turns out that managing interest rates based on presidential vibe rather than actual economic policy tends to be a bad idea. Who knew? Central bank independence isn't a nice to have. It's the only thing that stops politicians from screwing with interest rates for their own gains and torching the whole damn thing. You need that firewall. Look, sovereign debt crises are the green mile for empires. America is exceptional, but it's not exempt from history. The yield spike and dollar drop might stabilize in the short term. Maybe tax cuts and deregulation or policy shifts offer relief. But the core problem, the debt, the political chaos, and the erosion of trust is not going away. The core risk here isn't just a recession, but a messy unraveling of the American-led economic order built over the last 80 years. And with it, your money, your job, and your future prosperity that is tied to that order. Here's the deal. The bond market just gave America a harsh dose of reality. Yields spiked to 4.5%, the dollar dropped 4%, driven partly by foreign sellers spooked by our debt-fueled chaos. The White House blinked on tariffs. The Fed is frozen by stagflation fears. And maybe our exorbitant privilege of printing the world's money is fate. We're looking less like a superpower and more like an emerging market drowning in $36 trillion of debt. So what should you do? Well, first of all, stay informed. Understand this stuff. Secondly, look hard at your own debt. Rising interest rates hurt. While this might all be a bargaining strategy on behalf of the administration, once confidence is out of the bag, and it certainly looks like it is, it's hard to get back in. Trump may be satiated by gestures, but trade deals take a long time to negotiate. One between Canada and the EU took 7 years. Markets don't like that length of uncertainty. Third of all, I would say build a financial plan that is resilient enough for an unpredictable world. It's hard to say exactly what is on the horizon, and we're probably overdue a recession. But of course, like all things in financial markets, it's a probability distribution, and things could get better from here. By being prepared and not spreading yourself too thin, you will be able to better ride the waves that come our way. And do me a favor, hit that like button if you learned anything. Subscribe down below and hit that bell icon so you don't miss my update on what happens next. And tell me in the comments, will the bond market be our savior or our executioner? And of course, as always, stay sharp out there.